It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, the smartest guy in the room. You know him as the Lord Governor of the great state of Texas multifamily apartment scene, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. It's a little warm outside, but it's not raining anymore, so that's good.
It is the absolute dog days of summer coming into Texas. And so how are all your apartment buildings doing with air conditioning? Are we keeping tenants cool in those buildings of yours?
Yeah, I think, it's a perpetual struggle if you own a bunch of apartments in the South in the summertime, it's AC season. So we got, May through September, you got to deal with that. But I think, fortunately, most of our stuff's a little bit newer, nicer now, so we don't quite have the problems we used to have with the kind of the first generation of the portfolio. But yeah, it's certainly a perpetual problem of all the apartment owners in Texas.
Yeah, it is always fun to deal with air conditioning units when it's 110 degrees outside. Not that hot yet in Texas, but it's going to get that way. And so, the cold weather up in Minneapolis or up in upper state New York, you need heat during the wintertime and definitely need air conditioning during the summertime down in Texas. So we're excited to have Michael Becker visit with us, spend some time with us, answer the questions that you have about what's going on in multifamily properties. He is where the rubber meets the road. As you know, Michael Becker is a former banker, commercial real estate banker for one of the largest banks in the country. As you know, he led his division many, many years in a row for total production. He knows how to put the transactions together on the debt side. And then over a period of time, he transitioned over to multifamily ownership. So he went from a loaner of money to an owner of real estate. And so we're excited to have him on the show. Michael, before we get going and before we start to ask you some questions, don't forget, and we're announcing it right now, the Old Capital Conference coming on in September 22nd and 23rd. And this is our 5th annual conference. And if you've been to them before, they are super exciting. So super excited that we want you there. If you are thinking about getting to multifamily or you're in currently multifamily, what a great opportunity to network with some of the best multifamily operators, bankers, equity providers, all the groups that surround multifamily. If you're just getting into it, you want to be part of that. So on September 22nd, 23rd in the great state of Texas, in Arlington, Texas to be specific, and we're going to have it at Globe Life Field. Globe Life Field, home of the Texas Rangers, and we're going to be doing the conference on the grass. Right where the baseball players are, we'll be on there right next to the pitching mound. We're going to have our tables and chairs right there, and the stage right there. We'll use the right center field monitor to show our videos and all of our slides, and you are going to be on the field where the Texas Rangers play, the New York Yankees, or they play the Boston Red Sox, or the Chicago White Sox. You are going to be on the field. What an exciting time that's going to be. Michael, tell me a little bit about your feelings about the Old Capital Conference.
I'll be neat. We had it at the Cowboys Stadium, AT&T Stadium, 2 years ago, Paul, I believe, was the last time we did it in person. 3 years ago. The last time we did
3 years ago.
Yeah. And then House of Blues 2 years ago and virtual last year. So excited to get back in person. And I know you had the Old Capital speaker series here recently, and that was, 300-400 of our closest friends showed up for that. So I think events are back in person and everyone's excited, and this will be, certainly top-notch venue, and be good for the home team to have a winner on the field for a change with the Old Capital guys. So it'll be fun. And how do people get tickets for this, Paul?
Again, Old Capital Conference, oldcapitalconference.com. Go on to the web, download the tickets, be part of the solution. Find a partner, find some equity, find a lender, find out what's going on in multifamily. We're going to have the best of the best there. As Michael recalls, is that, our conferences are, world famous. I mean, usually have 750, 800 people show up for these conferences all throughout the nation, all multifamily people. In this one, we always have great speakers. In this one, we're not going to reveal that until maybe next month. But speakers in the past that we've had Coach Lou Holtz came in and gave us an update about what's going on, about being a better team member, doing the right thing. We've had Roger Staubach when we were at Cowboy Stadium. He spoke, was throwing footballs, signed footballs into the crowd. Great information about Roger Staubach, who's probably more famous being in commercial real estate than he was throwing the football. Even though he was the Heisman Trophy winner and the Ring of Honor Hall of Famer in multifamily and commercial real estate, he won the Oscar. I mean, he was the guy in multifamily and commercial real estate. Prior to that, we've had some great speakers, and this one is not going to be, you don't want to miss this speaker coming up. So we certainly would want you to go to the oldcapitalconference.com and join us for September 22nd, 23rd at Globe Life Park where the Texas Rangers play. So super, super excited about that. Mike, we have many questions today, many questions that have come in from our friends throughout the nation that have written in, wanted to kind of probe your mind about what's going on. But let's just kind of lead off about, and this was actually a question that was asked at the conference or the speaker series this week. Is Mike, what's your take about what's going on these days, and give me your feeling about is multifamily still good?
Yeah, we had Greg Wild on recently talking about kind of the state of the market from his perspective, and kind of what he was talking about is kind of what we are feeling day to day, Paul, just at the properties. I mean, the market is extremely white hot. I mean, occupancy is extremely high for historical standards. We're seeing tremendous rental rate growth. Now my portfolio, particularly now, we don't have too much workforce housing left. We just have a couple deals that are probably before the late 90s anymore, before the year 2000, Paul. So most of our stuff is kind of newer, nicer, A minus. But I mean, we're seeing really healthy trade outs, double digit average trade outs from the old lease to the new lease are going up over 10%. We're seeing, kind of that 4 to 5% on renewals on top of that. So, I mean, the market's absolutely white hot. That's a really large numbers for historical standards. I mean, I think if we can grow, 2.5%, 3% on an annualized basis, we're excited. And I think, when you average it all out, it's not going to stay at these numbers, Paul. But I mean, I think that's what worth in our portfolio being, somewhere between 6 and 8%, and Austin kind of that pushing that, 8%, probably more in Austin. It's even hotter than Dallas but they had a little lower base from a year ago than we did in Dallas Fort Worth, and San Antonio is pretty similar to Dallas Fort Worth. So everything's going really, really strong. And, so occupancy, rental rate growth, all the metrics you want to look at are doing really strong. And we didn't get absolutely crushed on taxes this year. So that was a little bit of a relief from last few years. We actually had a little bit of a reprieve being, month, or I guess a couple months of the tax process, where I think it's going to be a relatively decent year. I guess we got to clinch for 2022 and see kind of how that goes. But, all in all, everything's really strong. And then kind of that's the operational side of it. You go into the kind of the sales side or the investment sales side. I mean, that's absolutely white hot. I mean, all-time low cap rates and all the major metros, Texas. And I think it's kind of generally the same across the country in large part. We're seeing just a ton of interest, ton of capital really driving, these pricing up quite a bit. So, I mean, we just sold a deal here recently, for, really large, I think it's $50,000 a unit over what we bought it 4.5 years ago. And, it's pretty healthy growth, like 45% above what we paid for it. So, I mean, it was unbelievable to see kind of the pricing really go where it has gone. So, everything could be more bullish in the near term. And we're seeing the eviction moratorium is finally about to go off. They extended it one more time here recently. So through the end of July. But that's, really most of our portfolio. We only have one asset that has, any serious level of delinquent tenants that are, should be out that we can't get out. And that's in the People Republic of Austin, right? In the Travis County, that's the only one left. But everything it's not in Travis County in Texas. I mean, we're down to, 1 or 2 tenants that still kind of work in the system that haven't even got the rent relief funds or have been able to evict or just skip on their own. So, the portfolio from a collection standpoint is pretty healthy. So everything's really bullish. I'm sure you're seeing that in your day-to-day life, Paul, with just kind of the investor demand for debt is probably at all-time highs, I would imagine.
Without a question. And, there's so many different avenues and venues to get these transactions funded that, if you need the money and it makes sense, there's money that's available out there. Now, we talked a little bit about, we've seen a lot of the cheerleaders out there trying to get people into multifamily. I mean, they've done a great job being educators and mentors to get people in. Now, we try to pull the curtain back a little bit and talk a little bit about some of the challenges that you see maybe in the future about what's going on with multifamily. we talked about your transaction that you just recently sold, but the number one question I get that comes up is, Paul, when you guys bought these deals, financed these deals back 3-4 years ago, cap rates were X, and now they've come down to Y. How much farther lower can those cap rates go before it gets, they can't go down any farther? So my question to you, Mike, is at what period of time do you think cap rates are just going to stall out and then maybe start going back up?
Yeah, I keep thinking they can't go lower than they do. So we've been having that conversation for a while. So I'm trying not to get too ahead of my skis, thinking that it can't go lower because it certainly can.
Sure.
We're seeing historically low interest rates. Even the 10-year as we record this is somewhere around 1.5%. So while that's up quite a bit from the trough was around 60 bips maybe towards Q3 of 2020 as kind of the all-time trough, and kind of snap back quite a bit from there. But we're seeing robust economic activity. We're seeing that in our rents. Our rents are going through the roof because everyone has money and the jobs are coming back in a big way, and we're seeing a lot of population migration into the major markets and across the Sun Belt, really, Texas to be specific. So we're seeing, if we see 6-8% rent growth, think of it kind of like a growth stock, kind of like your Tesla stock. People are gonna pay a lot for future growth and income. That's kind of what we're seeing with these really low cap rates. People are very bullish on rental rate growth. They're paying more and more for that kind of future upside and future rental rate growth. And it's materializing in real life. So I think that's going to just fuel more and more demand into the space. So I'm not on the camp that we're going to see cap rate expand, right? So I would think that it's going to be probably around this range for the foreseeable future. I don't think we really see it kind of expand. I guess really the thing that would probably make it go upwards would be some major increase in interest rates. So it would probably be the thing that would make that go up. And I don't know if that's going to be a thing because you listen to the Federal Reserve. They're going to be lower for longer. I just don't see them hiking in any material major way in the next handful of years. Maybe they kind of slowly do it, but I think they'll let inflation run hot before they really raise rates and kind of collapse the economy.
Yeah, another part of that equation too is that people who currently own commercial real estate, whether it is office or retail or something in that genre, that that's a very difficult place to make money in still these days. I don't think I hear very much stuff going on in retail. In fact, I talked with some people about trying to get into triple nets that have retail components to it, and it's not only is it difficult to see how long the leases are going to be on these properties, but if you buy them, is that business still going to be around here in 6 or 7 years? Is it just going to be compromised into an internet type of company, and then you're just going to be left with a box? The only thing I see sometimes is Jack in the Boxes or Wendy's or something, that these fast food places, I think they tend to have more sticking power because it's kind of something that has to be purchased, and there's a large margin in some of that stuff. But just typical retail, they're still getting crushed, as you can imagine, especially coming off the pandemic. These places have done tough business, and very difficult to find employees these days to operate these properties. Again, pulling the curtain back a little bit, we had the Old Capital Speaker Series, and we brought in 2 asset managers, that one from that operates within the Fannie Mae group and one that operates within Freddie Mac, and they were here. They came in from different parts of the country, and they spoke in front of the group this week. And I just felt that they had some great information about what's going on. It's not so much going into the loan; it's what happens after you close the loan, and what's the relationship between you as a borrower sponsor and Fannie Mae. So the biggest thing is that I think they came out is if you liked being an IT engineer, or somebody that was maybe in marketing, or somebody that had a good corporate job, and now you've transitioned over to the syndication model and you want to be an apartment owner. Well, if you screw up after this loan closes, you're going to probably never do business with Fannie Mae or Freddie Mac in the future, and you'll probably be working yourself back into that job that you didn't like before. So that's one of the things I think that came out of that meeting is you have to be transparent with your lender. So if you're in the syndication business and you want to continue on being a syndicator, you have to have 100% clarity with your largest partner, and that is Fannie Mae or Freddie Mac in these transactions. And so, Mike, give me some of your feedback. You're a large operator, and you haven't had any problems with Fannie Mae or Freddie Mac, and you're on the good boys list. But talk about some of the things that you've seen before, just common knowledge of just industry chatter about how some of these people get in trouble and they find out that Fannie Mae, Freddie Mac in the future is no longer going to be an option for them.
Sure.
Or that non-recourse loan can become a recourse loan if you do something bad.
Yeah, really kind of three categories, really, Paul. I think one would be kind of the worst one, really, is kind of, if you commit fraud or misrepresent something or materially withhold something material around the property, like, you had some insurance money and then you don't disclose that to the lender and you put it in your pocketbook and you don't put it back into the property. That'd be certainly a way to get on the bad boys list and trigger recourse on your loan. So something along those lines. I think the other one would be, not spending money on the property, doing a lot of deferred maintenance. I think that is, certainly something that would be, they talked quite a bit about. So, you have these covenants in your loan agreements. So you got to maintain the property and, good workmanlike order and cure all the deferred maintenance. And you'll get these, annual or maybe biannual inspections that they'll come out to your property and check up on you to make sure that there's not any major potholes and trip hazards and your siding's falling off and things like that. So if you have a lot of deferred maintenance, that'll be a way for the lender to potentially make you order a second property condition assessment report. And if that comes back with a few $100,000 worth of immediate needs, and they're gonna come to you and ask you for that money. And if you don't have that money, you're gonna have yourself a problem, right? So I think that is certainly certainly another way to kind of get on the bad boy list for sure. So I mean, those are probably the top two that come to mind. Is just not taking care of your property or just not disclosing something, or I guess probably the third way is not reporting, right? So just kind of going dark on your lender and you're not doing your quarterly updates with your rent rolls and income statements or your annual borrower PFS and certifications and things like that. So you just making sure you communicate with your lender. So communication really was, I guess, kind of the main takeaway from the talk from the two asset managers, that and keeping your asset in good order. And they don't care if you promise your investors a rate of return. They expect the property to be in good condition. So if that means you don't pay money out and you got to put it back in the property, that's what it means. Or if it means you got to put your hand out and get more money, or you as a partner got to loan the partnership some money to keep it up, that's what it means.
Absolutely correct. There was a woman that asked a question from the back about if I were to put a syndication group together and I needed, a number of KPs, key principals in the deal. So I'm going to be a KP as a sponsor, and I'm going to have a couple other people to qualify for, the management of multifamily, check net worth check or liquidity check, and I have to put this group together. But somebody may have signed on a loan that was somebody else, and that transaction went bad. Can you have that person come into your deal if he's already on the bad boy list? And we call the bad boy list the A check. If you're on that bad boy list and you want to bring that person, it's going to be very difficult. If that person's already on the A check list, it's going to it's like, again, I've said it before, think of a 2-year-old, then you have a set of car keys. You start shaking that car key in front of the 2-year-old's face. That's the immediate thing that they're going to focus in on. They won't look at anything else. And that is what Fannie Mae and Freddie Mac are going to do, is that if you have somebody that comes in that's on the A check and you are trying to bring them into your sponsorship group, Fannie and Freddie are going to focus in on that, and they're not going to allow that deal to go through, and that may collapse your deal. So you got to be very, very careful about that.
Or if you signed on someone else's, I think the question she asked you, if I sign on someone else's loan as a KP, but I'm not the main sponsor or the general partner of the deal, the general partner's messing up, how can I force them to give me this or give them that? And I think the answer is that you really can't, right? I mean, that's kind of part about knowing your business, and that's kind of like the risk of these deals. And these deals are non-recourse, so that's what everyone wants. But you can certainly do some sort of action that triggers recourse and triggers that. So, and it doesn't necessarily have to be you. If you're just on the loan and you're the main partner or the lead partner doesn't do what they're supposed to do, then you got some exposure here. So I know 10 years ago, well, these people wanted to quote unquote, get their country club membership, right, and sign on anything and everything to try to kind of build a track record. So it's just not that simple. You should there's a level of risk in that, and you need to understand who you're getting into business with for sure.
Yeah, absolutely. So a little potpourri of information today. Anything, Michael, that you thought was important that everybody should be knowing about right now, about this time in the multifamily cycle?
No, I mean, I think it's still it's about as strong from a fundamental standpoint as I've seen it. So, I mean, I think we got quite a bit of run ahead of us, Paul. I really do. I think really bullish, at least on the majority of the Sun Belt markets. I mean, I think we're seeing the population and migration and jobs are starting to come back quite a bit, and there's wage inflation, which will put some upward pressure on our operating expenses, but it's also going to hopefully give us some headroom to push rents even higher and higher, and that's kind of what we're seeing right now. So I think all in all, it's looking good. It should be for the kind of intermediate term, call it like 2-3 years. I don't see any major storm clouds on the horizon from what I see now. Now, I reserve the right to be wrong, and something can come out of left field, obviously, but I think the consensus is everyone's pretty bullish on Sunbelt's multifamily, and I think we're going to see quite a good run for a few years with a pretty healthy rental rate growth.
Yeah, absolutely, I agree with that. So, tell me a little bit about what SPI stands for and what you guys do over at SPI.
Yep. So really what we're focused on this year, Paul, is just doing high quality deals. So we got a 2-property portfolio that we've been working on for a little while now, and that should be wrapping up here in the next handful of weeks. And so we just kind of put out large, high quality multifamily deals and syndicate them and pull people's money together syndication style. So that's really kind of what we focus on. So if people want to find out more information about us, the best way is simply go to a website, which is www.spiadvisory.com. It's SPI like spy advisory.com. Just contact us form, fill that out. We're happy to send out information about what we do and get you added into the list.
Sounds great, Michael. Thanks for spending some time with us and answering some of these questions. We appreciate it. Again, Michael Becker, thanks. I'm Paul Peebles. Have a great day.